Depreciation is one of those things you'll become familiar with once you're in business. In this video, we explain what it is and how you calculate it. Assets, otherwise known as substantial things businesses own, mostly lose value over time as they get older. This loss of value is called depreciation. Businesses claim depreciation loss as a deduction expense each tax year. You treat depreciation like an expense and deduct it from your gross income when you do your income tax return. Meet Andy. Andy's got a plastic moulding business with assets. Let's talk about depreciation with Andy's new machine, new computer, and old truck. Andy has just bought a new moulding machine for her factory. As it is likely to last longer than 12 months and cost over $5,000, she knows she can depreciate the machine at the end of the tax year. That's the 31st of March. Depreciation rates are based on the expected life of the asset. In most cases, you can choose either a diminishing value or straight line method to calculate depreciation. If Andy chooses diminishing value, she can claim a bigger deduction in the first year, but the deductions will get smaller in later years and it will take longer to fully depreciate the machine. If she chooses straight line, she'll claim the same amount each year and the machine will be depreciated much quicker. Andy uses our online depreciation rate resource and finds plastic moulding machines have a diminishing value rate of 13% and a straight line rate of 8.5%. It's up to Andy which option she prefers. Andy also bought a computer. It was only $800. Since it's classed as a low-value asset, Andy can deduct the full cost of it in the year she purchases it, instead of having to spread the cost over the life of the computer. If you already own an asset and introduce it into your business, you can claim depreciation on the market value of the asset. The best way to determine market value of assets you want to depreciate is to get an independent valuation. Make sure you keep a record of any valuation you obtain. If you then sell the asset, you compare the sales price to the asset's adjusted book value in your fixed asset register. Any gain is taxable and any loss is deductible. Back to Andy. Andy received a valuation of $500 for her truck from a local dealership. Andy then decides to sell her truck. She puts an ad in the paper and sells it for $600. The truck had an adjusted tax value of $500, so Andy includes the $100 gain as income in her tax return. If the truck had sold for $300, that would have been a loss of $200 that Andy could have claimed in her tax return. Wrapping up, for useful tools and resources for business, visit business.govt.nz. For more information to help you calculate your depreciation, visit our website ird.govt.nz.